It's only 9% of companies that make a clear link all the way from business model through to strategy, key performance indicators, and to remuneration, because at the end I want to know that executives are being paid to achieve the strategy. Hi, so I'm Shah-Coulon. I'm an executive director at EY. I run EY's corporate governance team. So EY's corporate governance team has just released a publication, Reflections on the Past, Direction for the Future. And this is our analysis of 100 FTSE 350 annual reports with years ending in September 14 to December 2014. And really we did it because it's the second year of reporting under new regulations. So it's really just to see the trend in reporting and also to help companies actually enhance their ARAs further. I think in this day and age where you have almost 24/7 on-demand information coming from the market, it is a good question as to are annual reports used. However, I think annual reports still remain the key port of call for anybody trying to find out more about the company. So yes, you have the website, yes, you have quarterly reports, half-yearly reports, but the annual report is the document that probably goes under the most diligence, both at the company level, but also they're all audited, so that there's a little bit more rigor that goes into the annual report. So interestingly, reports are still getting longer. There's this constant tension between companies trying to report clearly and concisely, and yet increased regulation driving more disclosure in annual reports. I think regulators can play a role in helping companies enhance their annual reports. Firstly, if you look over the last few years, there has been so much regulation leading to increased disclosures. Sometimes those regulations overlap with other regulations, so there's a need for regulators to think more cohesively and act together. They also need to kind of revisit whether the actual aims of the regulation are being achieved. So if you take 2 years ago, there was a need for companies to disclose greenhouse gas emissions. Is the annual report the best place for companies to disclose greenhouse gas emissions? I think it's a very noble thing to reduce greenhouse gas emissions, but is it the right place for this disclosure? The other thing is that I think regulators can provide clearer guidance on materiality. So I think materiality is a concept that everybody struggles with, but companies are best placed to actually determine what's material or not. But if there was a little bit of a steer from regulators as to what is material, what is not, and how companies can make the judgment, that would make it easier. And the last point I would make is regulators should encourage innovation, should encourage experimentation. Think about how you link various concepts that you use in your annual report. So all the way from strategy, business model, key performance indicators, to remuneration and reward. Because that link is essential. If you cannot articulate that link properly, then you aren't telling your story properly. Don't just roll forward from last year blindly. Think about what you want to communicate and how are you going to do that. I'd also recommend that companies actually get a steer from senior members of the board, perhaps the audit committee, as to what they want in, because sometimes that half an hour conversation might actually drive better reporting.